When should you consider a refinance on your mortgage, whether it's for a primary residence, a second home, or an investment property? No matter where the interest rates are at today, the information that I'll be covering in this video cover a basic overview of the factors that you should consider when you're thinking of a refinance. If I haven't met you yet, my name is Connor Webb. I am a mortgage loan advisor, mortgage broker, and it's my job to assist my clients in guiding them into whichever loan product is going to be best for their situation. Whether it's for a purchase or a refinance spanning all different property types, I'm currently licensed in Washington, Oregon, and Idaho. I'm adding new states all the time. Make sure to reach out. My contact information will be in the description of this video. And if you take some value from this video today, please make sure to hit that like button and subscribe for more content like this. And with that, let's get into the video. The factors that we'll get into in this video when talking about a refinance are the interest rates on your current mortgage versus your new mortgage, the loan terms on your current mortgage versus the new mortgage, and then the overall closing costs and the fees associated with completing a refinance. So first off, what is a refinance? Essentially, a refinance is paying off your current mortgage and replacing it with a new mortgage with new loan terms. When you sign the final paperwork on your mortgage, you are locking yourself into those terms on the loan, whether you sign on to a 15-year mortgage, a 30-year fixed mortgage, or if you have an adjustable rate mortgages. Those different loan types have different terms associated with them. And when you refinance, you are paying off that existing loan and replacing it with new debt. The first factor you'll need to consider with a refinance are the interest rates of your current mortgage and the new potential mortgage. Take a look at your most recent mortgage statement and see what the interest rate is on your loan. At the same time, take a look and see what the principal and interest payment on your mortgage is. As a part of your mortgage payment every month, you likely are also paying for property taxes and property insurance as a part of your payment. Those amounts are being sent to your escrow account, and your property taxes and property insurance are not affected by a refinance. The only thing that really is are the loan terms, which is the principal and interest on the mortgage that you are currently paying. At the same time, when you get a quote from your mortgage advisor on the new potential mortgage, you'll want to look at what the new interest rate might be and what the new principal and interest payment might be. It's worth noting that the larger of a loan amount that you currently have, the more of an impact on a monthly basis a lower interest rate will have. If you've owned the property for more than a year, then you likely have noticed that your total mortgage payment that you're sending out every month has been increasing on an annual basis. This is likely due to the fact that over time, as property values continue to increase, your local tax assessor that works for the government is going to be stopping by and reassessing your home every year. As your property value increases, your property taxes are likely increasing. Also, make sure to look at your homeowner's insurance policy, because that might be increasing on a yearly basis as well. The loan terms and the total principal and interest payment that you agree to will not change for the duration of the loan. And with interest rates in general, if your new interest rate will be around 0.75% to 1% or more less than your current rate, then it's probably time to look at a refinance. Keep in mind again that the higher of a loan amount that you have, the less of a drop in interest rate you need to have a true impact on your monthly payment. Here's a generic comparison of what a difference in interest rates might do for you. This is comparing two different loans. Both have a loan amount of $500,000. Both are for a 30-year loan term. The loan on the top has an interest rate of 7.5%. The loan on the bottom has an interest rate of 6%. With an interest rate of 7.5%, your total monthly payment for the principal and interest alone would be just shy of $3,500 a month. And the total interest that you'd be paying over those 30 years, those 360 payments, would be $758,586. Keep in mind that this is just the principal and interest. The property taxes, property insurance, and HOA payment are not included in this. Compare the 7.5% to the 6% on the bottom. With a 6% mortgage, you'd be just shy of $3,000 a month, and you would have a total interest payment over those 30 years of $579,000. So on the short-term basis, if you were to refinance from a 7.5% to a 6% mortgage with this exact scenario, then your principal and interest payment would drop by about $500 per month. And when you compare these two loans over the 30-year period, you're approaching $200,000 of savings on interest payments that you're making over those 30 years. Keep in mind that the larger of a loan amount that you have, the more of an impact the decrease in interest rate will have. So if you were to have this same exact drop from 7.5% to 6%, but you had a $100,000 loan amount, the total decrease on a monthly basis would be much smaller. On top of the interest rates, you want to consider the overall loan terms of your current mortgage compared to the new mortgage. How many years do you currently have left on your mortgage? Would you be looking to restart on a new 30-year loan term? Would you be reducing to a 15-year loan? Or what duration would the new loan amount be? You'll also want to run the numbers and consider paying the same amount that you were prior, just on the new loan with the lower principal and interest payment, So potentially you could pay it off faster than the 30-year term if you were to restart that term. Or would you just want to start paying that lower monthly payment and proceed from there? As a part of the loan terms, you'll also want to consider what type of refinance you're looking to complete. A rate and term refinance is where you're purely just looking to lower the interest rate on your current mortgage. A cash out refinance is where you'd be looking to tap into your home equity, pull out some funds, and do whatever you'd like with that. However you'd like to use those cash out funds is up to you, whether you'd like to pay off your high interest credit card debt, pay off student loans, or just go on a vacation. That is totally up to you, but a cash out refinance is an option and makes sense in various scenarios. I'll also add that if you're completing a cash out refinance to consolidate debts, the interest rate matters less than if you were to be doing a rate and term refinance. For a debt consolidation refinance, it's all about how much you're saving on a monthly basis by paying off those existing debts compared to what your new principal and interest payment would be on your mortgage. So even if your principal and interest payment on your mortgage was exactly the same or slightly higher after the cash out refinance, if you were able to pay off, let's say $1,000 a month of credit card consolidation debt, then it still could make sense to do the cash out refinance even if the interest rate is the same. As a part of a refinance, a big thing you'll need to consider are the closing costs and fees that are associated with the refinance itself. No matter where you get a refinance done, there's going to be some types of fees associated with it. If a lender tells you that they're going to complete a no-cost refinance for you, I would turn around and walk out that door because they're not telling you something that is associated with the refinance. Some of these fees are going to be the lender fees to process and underwrite the loan. There might be application fees, credit report fees. Aside from the lender, there's going to be various title and escrow fees. The county will have to re-record your new mortgage on your property and take off your existing mortgage. So that process of removing title and adding new title is also going to incur a fee. You also may or may not need an appraisal when you're looking at your refinance. In some cases, we're able to get an appraisal waiver if the value of the property that we're using is conservative enough and the automated underwriting compares your value of the property to recently sold properties in your area, then the automated underwriting might come back saying that we don't need an appraisal because the value that we used is conservative enough. Another fee, which is completely optional, is if you're looking at doing an interest rate buy down. Depending on which day you're looking to lock in your interest rate, you essentially can decide whichever option you'd like to go with up to a certain point. There is going to be an interest rate for that day, which is closest to no cost out of pocket for you, but you can choose to pay that interest rate down, pay a certain fee at closing in order to have a lower interest rate, which will bring a lower monthly payment. You could also take a higher interest rate to potentially get a credit back to apply towards these closing costs and prepaids. Which option is best for you is going to be completely dependent on your scenario, so ask your mortgage advisor and have that conversation and ask them what they would recommend. As a part of the refinance, you may also be able to roll in these costs associated with the refinance into the new mortgage to help reduce the total out-of-pocket that you're paying. And what we'll do is we'll plan to close on a refinance in a certain month. We'll have the client skip that monthly payment and instead they bring that payment at closing. That allows us to keep the new mortgage payment slightly lower than if they were to not bring that payment in. And typically, whichever month you close on a mortgage in, you prepay the payment for the remainder of that month. The next month, your first payment is building up, and then your first actual mortgage payment isn't due until the first of the following month. So if you were to close on a mortgage October 15th, you would prepay for October. You wouldn't have a mortgage payment in November, and your first mortgage payment would be due December 1st. That isn't always the case, but it is a generality. And the last factor to consider, and definitely reach out to your mortgage advisor to have them run numbers for you and to help with this, but it's figuring out what your break-even point is. Your break-even point is essentially at what point do you start benefiting from the refinance itself. So you would take the total costs associated with the refinance, divide that by the total monthly savings that you're incurring, just the principal and interest, because that is what is affected by the refinance, and that will equal your break-even point. So in general, I say that a refinance will cost somewhere between $3,000 and $3,700, depending on if we needed an appraisal or not. So you'll take that $3,700 divided by the $500 a month that we ran earlier in that scenario with a $500,000 loan amount, and that would get you a break-even point of 7.4 months. So that means that if you were to stay in this mortgage for at least 7.4 months, you would be benefiting beyond that point. This really is the most important thing to look at, is the break-even point on a refinance, and think about how long you might be holding that mortgage for, how long you might be in that property for, because that is a big factor in determining if a refinance makes sense right now or not. Thank you for taking the time to watch this video. I hope you took some value from it. Make sure to let me know in the comments below what you thought was the most useful tip, or if you have other questions that are real estate or mortgage related, please let me know and I'll cover them in another video. You can scan this QR code right here to get in contact with me if you have any questions or if you'd like to just jump on a call and walk through your scenario. Thank you for watching, and I'll see you in the next one.